It's Julian Crypto here, and with me is Shaun from Crypto Wizards. This is a software, and I would like to get more information, as much as you can tell me right now, Shaun, about your software. This is some kind of trading software or crypto market prediction software. Yeah. So I would like to have every information you can give me today about it. I would like to learn it, and maybe our audience also would like to enter this, because this is really interesting.
Yeah, no, thanks, Julian. Thank you for having me here. So really happy to be here from Crypto Wizards. Hopefully right now you can see something that says Crypto Traders Update. Let me know if you can see it.
Yeah.
Okay, perfect. So what I thought I'd do, because the software is just a tool, right? Software just helps answer questions. What I wanted to do for yourself and for all the cool followers you have is to go through answering some key questions. And this is based on really recent research. So most people have never seen this before. And then you will just see the software answering the questions. But what's more important is, what are the questions and can we answer them? So the first thing that I want to take you guys through today is, what happens if, because we are on the blockchain, what happens if we track every single trading account that trades a low cap crypto token? So for example, like if you're trading meme coins, what does it tell us if we can, in aggregate, in total, track how much pain people are in and how much profit are they in? And does that give us some kind of clear signal as to whether we should be buying or selling? So this is the first question that we're going to answer, and we'll use something called DEX bars to do that. The second thing that I'll answer for you today is, I've worked with traders over the last 5 years. So I'm a developer. I develop tools for traders. That's what I love doing. I do it all the time. I would do it for free. I love it. What have I learned working with traders over the last 5 years? What has worked and what hasn't worked? Well, there's really only one main thing that's worked well consistently over 5 years, and that's statistical arbitrage. So one of the things I'm going to answer for you today is, the people that do statistical arbitrage, or the ones that have written me, who have sent me emails, in aggregate, what have they done that's helped them be very successful? So I'm going to take you through that. And then finally, for the people that are interested in crypto and buying and holding crypto, they just love crypto. They want to, hold some cryptocurrency, but they're not sure now in the market which cryptocurrencies to buy. I'm just going to take you through some analysis that we did a year ago and again yesterday that helps to discern which cryptos are better value than other cryptos objectively. So not subjectively, objectively, which ones are actually a better deal. So those are the 3 questions that I'm going to answer for today. If that sounds good for you, I'll get started.
It sounds great. I'm really curious about that arbitrage thing. So yeah, let's move on.
All right, well, we'll get to arbitrage second. First of all, what I want to show you is this, because this is like recent analysis. We decided to put some algorithms that track every single swap that happens for now on Ethereum and also Binance Smart Chain to see, what happens when we look at the accounts in aggregate. And what we find is something that looks a lot like this. So this is the cryptocurrency Bobcat. I'll talk through these bars in a second, what they mean. But notice this over here, right? This big pink bar at the bottom here. It happens on this candle. This pink bar is not an indicator derived by price. Price did not help to calculate this.
Yes.
This pink bar, what is really, really fascinating to me is this is the sum of all these traders. So if we look at these traders here, this is the sum of all of those who are selling and are selling at a loss.
Yes, and this is on-chain data, yes?
This is on-chain data. Like you, I love on-chain data because
I like on-chain data.
unique.
And this is from which blockchain?
So right now, this is on Ethereum. I'll show you some more. We're running it for Ethereum and Binance Smart Chain. We want to get it for
Solidity
Solana, but we're not
software,
there.
yes.
Yeah. I'll show it to you shortly. So we'll have a look at some of these on there.
Yeah, this is really interesting. It reminds me this metric remind me funding rates on centralized exchanges, because people are selling. People believe that the asset will be worth less tomorrow. That's why they are selling it. And funding rates on the centralized exchanges is showing exactly the same behavior.
Yeah,
exactly the same sentiment. It's a different way to get this data, because funding rates we are getting from API from centralized exchanges, and we are getting it from just blockchain. But this is showing the same behavior, and it's working.
It's definitely working. I mean, I'll let you and I'll let your audience judge for yourselves objectively.
So you are aggregating this data by yourself?
Yeah, right now we've got machines running on dedicated servers just eating up. I mean, computation is huge, right? Because you are tracking every single account and how much profit that trader is in.
How many nodes do you have right now?
We're running 2 full nodes right now, plus the algorithm needs like its own node. Like it's a very intense algorithm, right?
Yeah, this is your own node, yes.
Yeah. We tried to do it like using other providers, but we are doing hundreds of millions of queries every day.
Yeah, this is really cool. I like it. And this is valuable.
Yeah, it's like you said, like with your funding rates, it's information which is not derived from price, right? It's separate data, and so it's much more useful. Yeah. So, but the thing here as well that's kind of interesting is we're not using time-based bars here either. So you can think of me like more like a retail quant. When you're doing with like machine learning and like more AI stuff with trading, we don't use like bars like this. This is a time-based bar here. So every 15 minutes there's a new bar. Every 15 minutes new bar. Every 15 minutes. But this for us is not very useful for this analysis, because time doesn't move price. Like for example here, there's a lot of time but no price movement. Time doesn't move price. What moves price is volume. So have a look at this, what I'm going to show you now. This same crypto, when you look at it from dollar bars, here is the true price. So this is now not moving with time. This is moving based on volume. Every like 500 USDT is a new bar. Every 500 USDT, new bar. Now, the true intention of this trader reveals itself. This is a scam. This is a shitcoin. This is going to dump. I promise you, this token, IT-1, this is going to dump. This is going to be
okay. This is really interesting because I don't understand it. So I assume this is interesting. Can you explain it to me? Because I assume that my audience also won't understand this.
No problem.
I'm not understanding this right now.
Yeah, no problem. It's really strange.
How it works?
It's very strange when you first see it. And I also didn't understand it. So let me do a better job of explaining this here. So here's a normal chart. Yeah, this is for cryptocurrency. Let's have a look. IT1. Yeah. And this is like what you're used to seeing if you're using TradingView or any charting package. TradingView is excellent. I love TradingView. But have a look here, right? This is a 15-minute time frame. So every 15 minutes, there's a new candle, yeah? So you are used to this. You've seen this before, yeah? This is like typical charting.
Mm-hmm.
Yeah,
of course.
So now what happens, like here, where between this time and this time, there's like no volume. There's very little volume. We just see price doing this flat, right? Well, right now, the way this is working is every 15 minutes, there's a new candle. Every 15 minutes, new candle. What if instead of looking at it from time, we look at it based on how much volume? So let's say for every 500 USD, we print a new candle. For the next 500 USD, we print a new candle.
This is something that I understand right now.
Okay, cool. So when we do that, this is what it looks like. Every 500 USD here, there's a new candle. And this is the true open, high, low, close candle. This is the real
So
chart.
it's going up. It's going up.
It looks fake, yeah? It doesn't look real. It looks fake, yeah?
What? Okay, but this is the price going up or volume going up?
This is the price going up. This is the candlestick price. This here is the volume. You can see the volume is the same on every candle, pretty much, yeah? And then this here, we don't see time anymore because this is still time left to right. This is still time over time, yeah? But it's not in equal time steps. It's not 15 minutes, 15 minutes. It's only when 500 volume is traded.
So because of that, you are saying that this is a scam, yeah?
Yes, absolutely. This token here, this is a scam because look, this is artificial. This price is not real. And I'm going to show you in more detail the good
You are
ones and
saying
the
that
bad
somebody
ones.
is trying to keep that price at the same level?
You see it. Listen, let me tell you, out of this research we did, I have seen hundreds of these. Yeah, hundreds. What people are doing, they are creating like 100 blockchain accounts. They are fake trading the price up. And then what happens is the price is going up. So like Dex Tools, Dex Screener, fantastic websites, yeah? Most people are using those websites. They are seeing, price is going up. Maybe I should buy this. And then they buy it. And the person with the bots know, okay, this is some new person. I'm going to dump now. I'm going to take their money. And they dump out. Yeah. So it's useful. Yeah,
but
exactly.
Really interesting thing. I see something like this for the first time, and I assume that this is valuable research.
By the way, me too, because we use this in like when you do stock analysis in machine learning, you use dollar bars, not time bars, yeah? But the question was, what does it look like if we apply it to meme coins, to shit coins, to low cap cryptos? And I promise you, once you see it, it's like, whoa, this is another world. So it's very exciting. Let me show you here in more detail. So actually what I'll do is I'll just show you live. So here's, let me look at Dogecoin as an example. So let's have a look here. Like Doge is very liquid, so it's not as interesting, but I'm going to show you anyway, because it's a real cryptocurrency that is always going to be here. So let's have a look here. Here you see where traders are selling in a lot of pain. Yeah, they're selling at a loss. So all of this red is sales volume. Here, they're selling at a loss. Here, look, another big one, selling at a loss. And look at the divergence.
But this is from Dex bars. This is not your tool.
This is my tool. This is Crypto Wizards. Dex bars is it's experimental. So we just created our own domain for it because we're isolating right now.
Oh, so what I see in this is yours, right now?
Yeah. So Crypto Wizards members, they just sign into Crypto Wizards and they click and they get here. Like, I'll show you. So really for example, I love that you're letting me show software. I love building software, so this is always fun. So here, when they click on Dex bars here, when they signed into Crypto Wizards, then they are here. They're looking at Dex bars, right? So here you can see the buying that's happening. The selling at a loss down here. Yeah. And that's really interesting because what we see happen afterwards here is we see, 20% profit here. Probably it's going to go up here. Now this is Dogecoin. So you're not going to make loads of money on Doge. Like the low caps are where the money are. So let me show you some other ones here. Let's have a look at some others I just wrote down today. I was analyzing this morning. So this one, TNet. I don't know what TNet is. Yeah, it might be a shitcoin. I don't know. But have a look at the information that I'm looking at here. So for example, here's where people are selling at a loss again. And this is now against wrapped Ethereum. So this is about 1.5 Ethereum. They sold at a loss here. And then now look at price after that point. That's like 100%, 173%. Yeah, it's huge. And something else interesting I've noticed, I don't see it so much here, but when people start selling at high profit, very often the price starts going down. So if the trend has been up and then they're selling at a profit, it goes down. So it indicates before it happens. Really interesting. Here, I'll show you another one. We got loads. I could be here all day showing you these things, but let me show you. I'll show you just a few. Let's have a look at, I think.
What intervals do you have here?
So the way that so these are all dollar bars. So the way we work here is, right now it's every 3 Ethereum is a new bar on this one, for example, yeah? So every 3 Ethereum, every 3 Ethereum, every 3 Ethereum, pretty much. And then if I want to increase that, I can say, okay, maybe I want something like every 12 Ethereum. So I can magnify the time frame.
It's a volume, yes?
Yeah, it's all based on volume. It's all based on volume. And have a look here. So same thing we looked before. Have a look at this, by the way. This is really interesting.
So this is not time frame, it's volume frame.
This is volume frame because it's more valuable. So we just threw time frame out. We just got rid of it.
I have a question. Is this used anywhere else?
No,
Only you are using it?
In crypto, only we are using it. And it's an experiment. So we didn't know, will this be good? We didn't know. But it's proven to be good.
How did you find this idea?
So I do a lot of I teach a lot of programming on Udemy, and so I taught machine learning applied to stock and crypto trading, and we had a lot of students in that who were asking, how should the like candlestick data, how should the data be structured for machine learning? And so when you're doing machine learning, you convert time bars, you convert them to dollar bars because it's more valuable. And that's how I knew about it, but I'd never seen it applied to crypto before. Mm-hmm. So this will happen, like more quants will be doing this already in crypto, but they probably don't have tools out yet for it. So yeah.
Nice.
Cool. Sorry, I know I'm talking fast. There's so much
I understand everything.
You.
You are not talking fast, by the way.
Okay, good. You let me know if you need me to stop or something.
Ben Shapiro is talking fast.
Yeah, he is. Yeah, he is. I won't talk as fast as Ben. So this is another example here. Now I want you to see down here. It's not so obvious, but can you see at the bottom? These here are like purple color, these ones down here. Yeah, so very like slight. So what this is doing, this is very interesting. It's looking at all the trading accounts. So for this token, we're tracking every single trader account. The ones who have not sold, they've not sold their crypto. If they sold at that price, so at the price here, at the price here, at the price there, if they sold, how much profit or loss maximum would they make? So unrealized profit and loss. So it's like the pain not yet happened. Yeah. So have a look here. When it's purple, that means people are in aggregate at a loss, but they've not sold. And then we see this big spike here again, about 1.5 Ethereum with the purple. Have a look what happens after. And I see it again, I see it again, I see it again. I mean, you can also see it here, by the way, purple. Hang on, I lost it there, purple. And the same thing happened here. And now take a look at this. Really interesting. 460%.
Yeah.
What is that?
But
crazy.
Every candle is 3 Ethereum, yes?
Yeah. So every single one here is 3 Ethereum. Yeah. So sorry, I have to look up here. Every candle here, 3 Ethereum, pretty much. Like some of them are, the volume you can see is like flat. Some of them, slight deviation, but it's not going to be perfect like capture of volume. So, but generally you can see here, volume is flat. Like the whole way along. So I can actually show you how the algorithm is working. So you'll notice here the volume, for example, here it starts really low and then it starts increasing. This is the algorithm learning. It's learning a new crypto and it's going, okay, this crypto trades more volume. And so it adjusts. It adjusts based on the trend of volume change. So it's like automatic adjustment, basically. Yeah. So yeah, it's pretty interesting, man. I could show you a lot more, but I've got some statistical arbitrage stuff I can't wait to show you as well.
Yeah, show me this.
All right.
Interesting. And
So,
how many servers do you have to
man.
compute this?
To compute this, we've got, we're spending at the moment about £700 a month just for the computations, and then maybe another like £100 for like the front end slash other stuff.
So I assume maybe 20 servers.
I mean, it cost me under 1,000 to run this. No. So servers, what we have for servers is we have fewer, much more powerful servers. So 128 gigs of memory, 20 cores, CPU, like stupid. Yeah. But you need it because if you think about it, this algorithm has to keep up with every single trade in aggregate. It's like the computation is the most difficult thing I've ever worked on. Like it took me months, bro, like months to work out how to make this happen.
Yeah, I assume this. I assume that it's not easy thing. I was talking about mapping blockchains, different blockchains with many programmers, specialists.
Yeah.
And always they told that this is thing for months, not all for weeks.
Yeah, man, you know yourself because you have some really good software, and you know, like you spend months in development, and sometimes people never even see it, you know.
Yeah.
So for this tool, there's a lot of other ones that never made it, you know.
Yeah.
So yeah, I'm with you. So I think the next thing, if you'd like, we can talk about is this statistical arbitrage, and you know what is actually useful and what should people ignore with that. So we'll probably get into that very quickly. If you don't know what statistical arbitrage is, it's actually very simple. It sounds complicated, but it's simple. It's just pairs trading with some statistics involved in that process. So more like advanced statistics. So here, for example, the blue line could be Bitcoin versus Ethereum, and the pink line could be Solana versus Aptos. And you'll notice that, you know, they look like they are sort of correlated, they move similar, but sometimes they don't. Like one price goes down, the other goes up. And then, so what will happen here is a pairs trader will, for example, here, they will go short on BTC Ethereum, so BTC ETH, and then what they will do here on the other token here is they will go long on, say, Solana, whatever this was, I don't know, Solana Aptos or Solana, say, USDT, whatever it is. They'll go short on this one and long on this one. So really what they're trading is the difference between these assets. And that's pairs trading in a nutshell. So let's take a look at what that looks like in reality with live data. So at Crypto Wizards, we've been doing this now for years, and every year it's becoming more and more advanced. And in fact, this year I'm expecting to do some more upgrades to this as well. For example, we're tracking on Binance US, Bybit, Coinbase, DYDX, and also Forex. I'll show you Forex as well. It's quite interesting. But we're tracking where are these opportunities. So we have more servers for this one, more servers running in the background, you know, scanning exchange data and trying to work out if we had traded these, how much money would we have made, and what is like the Sharpe ratio, etc. And I want to show you something first before we get into the analysis here. Let me go into daily, because we're not doing hourly for Forex, we're doing daily. For Forex, you'll notice the Sharpe ratios here are much lower compared to crypto. So Forex, it's not that profitable compared to crypto. Like if I go to crypto, for example, you'll notice here, like everything is like green. And so what I've learned, first of all, is that crypto, for pairs trading right now has got to be one of the most profitable, most appealing things, trading vehicles to make profit. So for example, let's take a look at, I don't know, I'll just pick on any random one. Let's pick on this one here, LSK USDT versus BTC USDT. And let's just go into more detail. So this is showing me the price change of the two assets. And this here is showing me, you know, correlation and also co-integration. Now, for a lot of your viewers, they never would have heard of co-integration. Not many people have heard of this. Correlation, we know, like, you know, you can have an asset that moves like this and another one that moves like this. And we say, oh yeah, these two here, you know, these are correlated. They move in a similar way. Co-integration is far more valuable. Co-integration says, okay, here's your asset here, and you know, here's your other asset here. But the difference between the two, so if I plot it on a chart, the sort of, think of it, the price between the two, the difference between the two prices on a zero line goes like this. And this is far more valuable because here's when you go long, here's when you go short. Here's where you go long, here's where you go short. And so that's what we're doing here. This is this tool, the reason why, I mean, 80% of people, 90% of people at Crypto Wizards are using this. This is what they use. Because what they're trading is they're trading this line here, which is the difference between these two assets, right? So what they're doing is they're saying, okay, when should I go long here and when should I go short? And you can see this is much easier to trade this than to figure out, will the stock or will the crypto go up or down? Yeah, up or down is very difficult. Trading the difference is much easier because you can see here, these have been going like up here. Here's a good time to go in. Here's a good time to go short. It's much easier. It just channels sideways. It's much easier to trade this. And so this is like much preferred. And so the traders who are looking at this are wondering, when do I get in and when do I get out of this? And so, for example, here they use the Z-score. So the Z-score is like, in statistics, it just looks at, it's like an elastic band. How stretched is the elastic band? If it stretches a lot, go short. If it stretches negative, go long. And when I mean long, what I mean is you're going long on LSK USDT and short on BTC USDT. That's going long. Going short is going long on BTC USDT and short on LSK. So we're talking about going long and going short on the actual pair. It's a lot to get your head around. And so what we're doing with this is we run these back tests. I mean, this one here is stupid returns on this one. Yeah. You would have done well. But here's the thing, be careful here. As one of the leaders in financial machine learning, Marcos Lopez de Prado, there's a good quote. Yeah, very good quote. Backtesting is not a research strategy. Feature importance is. And what we're saying is backtesting is only good to know directionally, did this do well in the past? It doesn't guarantee the future. So, you know, I can't sit here and say, oh, you're going to make thousands. No, bullshit. A lot of people can lose money in statistical arbitrage. So what I'm going to tell you now is from the people that made money, what did they do? What did they have in common when they wrote to me? What did they actually do? And so now I'm going to share the secrets with you. Here are the secrets. Are you ready? Okay, so the first secret we looked at, I've already taken you through. It's to use co-integration as your metric, not just correlation. Correlation, they can move similar, but they can move apart over time and you're going to lose money. Co-integration is a much more valuable metric. And we can see that here, for example, this crypto here is very strongly correlated, but it's spread. So the difference between the two, it's not very good for trading. Whereas this one over here has co-integration. It means it's co-integrated and its spread is much better for trading. And it made over 100% return. So that's secret number one. Secret number two is something you might never have heard of. which is to follow something called the Kelly criterion. So the Kelly criterion is used for position sizing. And there are many videos on YouTube, very good ones. I've got one on here as well that's had a lot of good feedback. So definitely feel free to go and watch that. But the Kelly criterion looks like this. I'm going to show you now. If you say took 1,000 trades with 51% probability of success. So let's say your strategy gives you an edge of 51%. Yeah, so 51% of the time you win, 49% of the time you lose. Let's just pretend you have a little bit of edge. You are the casino, yeah? What this is doing is it's saying, okay, how much of your capital should you risk on every trade? Like, should I put 10% of my capital on every trade? Should I put 20%? Should I put 2%? What is the most profitable amount of capital to allocate to every trade? And how does that end up with? So if I start with, say, $1,000 and I put 1% of capital in, I end up with a positive return. If I put 4%, I end up with a loss. If I put 8%, I end up with a loss. And if I put 15% on my trades, I end up with a loss like ages ago, like I lose money. And so this is a very, very, very important thing to focus on here. I get a lot of traders who write to me and they say, oh, should I use leverage? And I can't give them advice. I don't trade for a living. I can't give them advice. But I always say, look at the Kelly criterion, because if you're using a lot of leverage, or if you are allocating a lot of your capital, that is objectively the reason why most traders lose, is because mathematics proves it. Like, it proves you will lose all your capital. And here's a real example.
This is your chart? You did this chart?
Yeah.
So you did with calculation, yes?
Yeah. So here, this is just the spreadsheet here. So you have a look here. It's just a spreadsheet in Excel with lots of random formulas, yeah? So here it's saying actually if the probability of a win is 52% and the probability of lose is 48. Now, if I hit refresh on this, it's random. It's a random calculator. So it shows me, I can just keep hitting refresh. Which is the best one? Which one would have worked? And most of the time, the higher the percentage, the more guaranteed you are to lose money.
So percentage is a leverage?
Yeah, well, like you can think of it like this. Let's say I've got, let me turn the size up here. We do it on a spreadsheet, right? Let's say I've got $10,000 to trade, or even 1,000. How much percent of my 1,000 should I use? That's what it's saying, is if I use, say, 1% here, then I'm far more likely to make profit over time. If I use 15%, I'm far more likely to lose all my money.
Why?
Because of math. So here, let me tell you. I'll tell you the reason why. So this guy, John Kelly, he worked for AT&T, Bell Labs. He wanted to know, in the world of gambling, in betting, what the optimum amount of his bankroll to put on a bet is. And he came up with a math formula. This is the formula. He came up with the formula. And so it goes something like this, right? Let's say you have $10 and I go down to $9. Let's say I lose this trade. Well, that there, right, is a, what is that? A 10% loss, yeah? I lost 10% on that trade. But to get back to $10, I need more than 10%. I need 11% or whatever to get back. So this is like the logic. If you have your capital and you are losing your capital, so let's say the first 10 trades go badly for you, it's going to take a lot more to recover that. And if you're betting a lot of your capital in one go, you're exposed, your risk is like significantly higher. And so the people that make money in statistical arbitrage make small profits often. That's their strategy. And so they're taking maybe 0.5% of their capital, 1%, and they're placing as many trades as possible. So it doesn't mean like if you have $1,000, it doesn't mean, oh, only bet $10. It means no, bet $10 100 times on different assets. Yeah. And that is
because of the
secret.
statistics. Yes.
Yeah. This is the reason 95% of traders lose. It's because of math.
Yeah. And I have a question, because you told me about the leverage. Yeah, I understand that leverage in the long term isn't profitable. I don't use leverage, and I'm telling it all the time not to use leverage, guys.
Yeah.
Anyway, people are using leverage because
don't use leverage.
They want to gamble. They want to be rich tomorrow with not work, not effort.
Yeah. I mean, I've done it. I don't know about you. Have you ever lost money doing leverage before?
Yeah, 3 times.
Yeah.
Low amounts of money. I mean, $200 I put in a futures. I lost it during night with no stop loss. Another time also around 200. So little amounts of money, just to confirm to myself that this is not something what I want to do.
Yeah, no, I'm totally with you. I mean, there is a time when using leverage is good, but not for people like us. But like if you are a Bitcoin miner and you are mining Bitcoin and you own Bitcoin and you want to protect downside, you can hedge. And so leverage is good for hedging if you own the underlying asset. But it's different. That's different to trading. That's not a trading strategy. That's a protection strategy. It's very different. Mm-hmm. So I'm totally with you. Like so many people, I had someone write to me and they sent me an email. They told me how much money they had lost in trading. And I don't know if it's a lot, because to different people, different amounts of money matter different things. Yeah. But to me, it was like, I was like, wow, that's a lot of money. And what I found out is this person's using a lot of leverage, just like you said. And I'm like, no, this is the fastest way to kill your account is leverage.
Because people don't calculate. They just don't know the rules of the game.
Yeah.
So we are on the same side.
I'm on your side. I will defend you.
So this chart is not correlated to leverage.
No, it's not correlated, but it's a similar principle, because leverage is still exposing more than X% of your capital to risk. So when you're using leverage, it's a similar principle, which is like your risk exposure is magnified.
Yeah, so
and
this
that's dangerous.
So I understand everything right now. So the statistical arbitrage is more efficient, more profitable when you trade hundreds of trades, different little trades parallel, than few trades with bigger amounts.
Yeah, definitely.
So I understand it, but if you want to do it, you need to do a fully automate. You need to automate it.
It depends. Some people. So I teach automation.
It's impossible to open 100 and close 100 positions.
I mean, it's ideal to have 100. In reality, you won't have 100. You'll have like 5 or 10. And I'll tell you why. Like 100 is ideal. Yeah, I'm like exaggerating. But in reality, you'll have 5 or 10. So I have 2 types of customers at Crypto Wizards. The first are people that want to build their own bots. So I give them the algorithm. They have the algorithm. They go and build their own bots, and then they say goodbye, and it's like, cool. They go and do their thing. And there's other people who don't want that. They have been pairs trading for, I'll give you a story. One guy, he was pairs trading for over 30 years. And he was using correlation. And he said to me, he was like, holy shit. He said, this co-integration strategy is working so much better. And he said, when I apply everything I know to crypto, he's like, it's like picking winning stocks on the NASDAQ every day. Like he was very experienced. He had years of experience. And so what he was doing was something that looked like this, like you said. He was making sure that he was trading many pairs. But what these traders are doing is they're also making sure that they're not trading the same pair twice. So for example, in this trade here, I've got Solana, yeah? So Solana versus ICP. Well, it's not a good idea. It's not terrible, but it's not a great idea to open another trade that has Solana because my risk is already exposed on Solana. So it's fine to open these three, right? But probably I already have a Solana trade, so maybe don't expose to Solana again. USDT is different. Like if this was all USDT, it's a stable coin. So not much is going to happen to USDT. It's just going to be USDT. But the point is try to diversify your risk. Try to have as many different tokens as possible in that portfolio. So that's the third thing, which is basically your point. And if you want more and you don't want to have to do it manually, then yeah, you have to automate it. But a lot of traders prefer to be in control because they're manually getting a sense of things and they trade very well. They're very profitable. For other traders, if they do that, they lose money. So to me, it depends on the trader.
Yeah, I understand it. If you want to use something for a long period of time with high amount of your capital, a high percentage of your capital, you should first do it manually most of the time and afterward automate it.
Oh, it's so true, man. Like so sometimes I'll get emails. Someone will say, "Oh, hey, I need a trading bot built. Can you build this a bot that makes something like 5% a day, or can you build a bot that makes 100%
5% a day?"
Yeah. So it's like, where do you start with answering that? So I usually say, okay, cool. What are you doing that's making that today that you want automated? And the answer is always, I don't know. Tell me what makes that money. So it's like, no, I can't help you. I'm not a genie. I can't do that. Different traders use different strategies that make sense to them. And most bots that are profitable, like 99%, the trader has some control over that bot. Like it's semi-automated. There's not many bots where you just set it to run for like 2 years and it makes money over 2 years and you never touch it. Very rarely, very, very rarely.
Yeah.
So yeah, very true. But if you're going to do this, then another secret here, and I actually learned this from a trader recently, they did some analysis to show, especially trading on DYDX, the decentralized exchange, some of the pairs have very wide spreads between the bid and the ask. And that is a cost of trading, right? So whenever you're looking at a pair, if your spread between your bid and your ask is very wide, that's a cost. You're paying for that trade. And that really, really hurts you in arbitrage. So what you really want is very highly liquid tokens that are very close on spread. So the cost of trading needs to be very low. And even better, some exchanges. So if you have a large bankroll, so for those of you who are watching who are like maybe working in a hedge fund or you're working in a prop firm and you've got a lot more size, then look for exchanges that offer a market-making rebate because you are literally getting paid to place those trades. And it's like wash trading. It's far better to get paid to trade than to pay to trade. So that's another big takeaway there as well.
So which exchanges you mean?
Oh man, they change all the time. When I did the course, I taught a course on Udemy on statistical arbitrage, and I chose the Bybit exchange. So Bybit was giving a market-making rebate. Any trader could sign up, and if they placed like limit orders and their position gets filled, they got paid for that. They got the rebate. And then 2 weeks after I launched the course, they removed the rebate. So KuCoin is one. KuCoin are offering market-making rebates right now to like partners with large size, but I don't know of many right now. Like I hardly know of any. But sometimes when exchanges want to promote, they offer market-making rebates. If you see that, that's a big opportunity.
Yeah, but fees and the spread is killing profits over time.
Yeah,
I'm really focused on lowering that costs.
Yeah. Yeah.
You know, on centralized exchanges, you have, for example, 1/10 to 2/10 of percentage, yes, of your trade you have to pay. It's a fee.
Yeah,
and on
no,
on
definitely.
decentralized exchanges, it's at least 2/10 of percent on PancakeSwap, or even more.
It's huge. It's huge.
Do you trade on decentralized exchanges sometimes?
Yeah, I do. Like, I mean, for me, most of my time is spent developing. I pay my mortgage by developing. But that said, I've also, like a lot of people, been very fortunate to do well with crypto. And I'm actually going to take you through a strategy I've used shortly that has really helped me personally. So I'm actually going to show that to you in a minute. But I completely agree with you. The fees for trading on DEXs are horrible. They're awful. But the returns on some of the tokens are also stupidly high. So it's like you have to figure out, like, for example, one strategy that I want to try now. I can't tell you if it works because I haven't done it yet, but I'm looking to try this. You know Ethereum, yeah? Ethereum's gas fees are very, very, very high.
Yeah.
Okay. But something I know, let me show you something actually. You'll find this interesting. I'm going to go here to a tool that I use. Don't get excited about this. I'm going to tell you what this is. Don't get excited about it. I'm going to tell you now it's shit. Don't sign up for this. It's terrible. Okay.
But this is yours, yes?
This is mine, but this here is shit. Don't use it.
Okay.
I'm only going to, it's shit. But let me tell you what I've noticed when I was building this. So because we're running like this Ethereum full node, what I wanted to do was scan through all these tokens on Uniswap v2 and Uniswap v3 and find out with a flash loan. So like simulating flash loans. So what you do is like you fork the mainnet and then you push a trade through a forked mainnet through a flash loan to see, was this profitable? And what this tool is showing you is which one of these was actually profitable when simulating that. So it's running all the time. And the only reason I keep this is I've got maybe like 10 people at Crypto Wizards who I don't know how they do it. I have no idea, but they use it. And if I take it away, they get very angry at me. So I'm just going to keep it here for now. But this is interesting. What this tells you is that on Ethereum, there are opportunities happening. And they are happening because the gas fees are very, very, very high. And so high gas fees means lower competition. And so that got me thinking. I don't know what you think. I'll tell you here what my idea is. So what I was thinking is with these meme coins, there are far more, say, genuine meme coins and low cap cryptos on Ethereum than, say, Binance Smart Chain. So Binance Smart Chain, like most of these are rug pulls. And then you have Ethereum where you have some credible projects, but the returns are very high, but it's very expensive to trade because of the gas fees and because of the exchange fees. But now I'm seeing there are some solutions out there where you can bid for gas fees. It takes longer for your transaction, but you can get in with much lower gas fees on Ethereum. But the returns on the low cap cryptos are very high. And so what I'm thinking is I'm thinking of basically trading over longer time frames, meme coins on Ethereum using some lower gas strategies. I don't know if it'll work. I've got no data for you, but it's just an idea. Yeah. Sorry, I don't know if that even answered your question. That was more of a rant on an idea.
No, it's all right. You know, you can go on.
I just love talking about these things, man. I mean, I've been living this stuff for years. You know,
I understand it. I love talking about things, my things either, you know.
Yeah.
So I totally understand you.
You know, I try to talk to my wife.
We are kind of geeks, all right?
Oh, dude, we are absolute. We are absolute geeks, except you are a younger geek with more energy than I am. So you will do better, man. You will do better.
Yeah,
So-
but you know, we are doing something which might change the world. I'm
Yeah.
every day I'm asking myself, you know, what should I do to be more remembered, to create things that are more valuable, not only for one part of the market, but for the whole market. Not only to, you know, make profit for some traders, but to make profit for whole society, community, you know. For example, ChatGPT, OpenAI's GPT models. It's game changer for everybody in the world. It's just pushing the world so much faster to the progress. Bots, humanoid bots from Tesla.
Oh, yeah.
You know, this kind of things are changing the world. What we are doing right now is nice thing for some people. I mean, for traders who maybe for hedge funds who want to get their income to the higher levels. But I'm always asking myself, what should we do to not only make some people rich, but to make everybody around rich?
Yeah. I mean, that's a lovely vision, and I totally subscribe to your vision. So I'm excited to follow your journey after hearing that.
I'm excited to follow your journey too, and you know, maybe integration of some different tools, artificial intelligence.
Yeah.
Maybe, you know, as we are talking about DEXs are so high cost.
Yeah.
So high fees on DEXs.
Yeah. I mean,
maybe there is no DEX right now. I assume that there is no DEX which is truly decentralized. I mean, with their infrastructure, because each DEX is hosted on Amazon Web Services or Google Cloud. But probably not DEX which is truly decentralized.
Yeah.
And we are seeing it because Uniswap, for example, was set by SEC some time ago to delete some pairs from their website. So they did it. So they are not fully decentralized.
No, it's not fully decentralized, and that's a problem. I think I share your thinking, by the way. You and I are very aligned on this. And just for people watching, Julian, you and I have never spoken about this before.
No.
But I promise you, I am completely aligned with you on this. So a couple of years ago, maybe 3 years ago, 2 years ago, I worked on a project for this on Solana, a fully decentralized exchange where people like you and I provide the liquidity. But here's the thing, right? A lot of Solana's data is backed up on Google Cloud. Like, first of all. So I think I was talking with a friend about something similar recently. I think the elephant in the room is actually blockchain itself. I think that what we need is an enhanced technology for storage of data, because it's the real weakness of blockchain right now.
Yes.
You know.
So what do you think about these projects like Internet Computer or Filecoin? Do you have any experience with them?
I do. I definitely do. I mean, I looked heavily into ICP ages ago, like with they have a very cool concept of these canisters. And being a web developer myself, like, of course, I'm like all over that. But here's the problem I have is when you look behind most of these initiatives, they run like startups from companies. It doesn't feel very organic like Ethereum or like Bitcoin does. It's got like there's still a strong element of like centralization and control around it. Now that might change over time, but I fundamentally think the technology of blockchain itself is a problem for scale over time for everyone. So for me today, I don't know what the solution is. I was thinking, do we move to a consensus mechanism which is governed by AI? Will that solve the problem? Or I don't have the answer. I think if we did, we'd probably be working on it right now. But I think fundamentally for these projects, something has to change. Out of all of the crypto projects that I think has the best technology, I used to think it was Solana. Now I think it's Sui. I think Sui by far has the best tech and no one knows it yet. I was buying Sui when it was like down, down, down. As it was dropping, I was just buying more and more and more. Like it's really good tech, but it's very centralized. And again, that's a problem,
Uh-huh.
I don't have an answer for you on that. I only have an opinion. Yeah. It's an interesting question.
Do you have an experience with internet computer, for example? Because they some time ago they announced that they are able to send bitcoins through their system, for a network.
Oh, it's interesting.
Directly on chain bitcoins.
Yeah, which makes sense because the problem that they're solving is giving blockchain web functionality. I mean, that's a huge achievement. I think what they're doing is fantastic. As a technology, it's really, really good. What they're doing is basically bringing the internet to blockchain. But I wonder, that's fine for people like you and me who are like nerds and are interested in maybe building with some of that tech now. But I don't see, I'm going to probably eat my words one day. I can't see it replacing Amazon Web Services, right? Yeah. Like it's the scale. I think the technology they're building is really good. Don't get me wrong. But I wouldn't want to bet my house on it. Not right now.
Yeah, but there will the law in Europe in 2028, something like this, or late 2025. Yeah. So in early 2026, there is going another law in Europe saying that all centralized crypto exchanges, if you want to withdraw money from centralized crypto exchanges, you will be obligated to tell where are you sending your crypto. So you will be obligated to tell exchange who is the owner of that crypto wallet that you are sending cryptos. So you will be obligated to whitelist every wallet you are withdrawing your money. So that's where is my
so you're thinking. So you're thinking like ICP.
Where's my thinking going?
Yeah.
I'm thinking that in 2 years from now, there will be a huge pressure for decentralized exchanges, even higher than now because of the law. And people will understand that many people, I assume, will start to using decentralized exchanges. And what I see now is that there are not the current infrastructure is not ready for this move.
No, it's not. But I share your vision, though.
Yeah.
Like everyone, like you and me are going to want to trade with each other. Like my vision is very similar to yours. Like I'll be able to go, cool, I'm going to place a trade or I'm going to send you crypto, whatever. And it'll happen 100% decentralized, 100%. There will be zero centralization in that transaction because we can do it today, but it's very clunky. Like it's very clunky, but that will happen for all trading. I think, crypto trading, in terms of blockchain from this perspective, the best use case is exchange of assets. But here's the problem. Yeah. So like if we talk about ICP, this is going to happen. To your point, this is already happening. They're building like fully decentralized or, highly decentralized website functionality, web building functionality. You will be able to exchange Bitcoin on it, etc. This is great. But here's the problem. I will be able to build any website I want and no one can take it down. That's a good thing because it means you and I can build an exchange that we can use that no one can take down. Here's the bad news. Somebody who wants to put up human trafficking websites or child pornography or terrible, like dark web type of stuff cannot have their websites taken down. So the tool is going to be there.
They are doing it anyway.
They're going to do it anyway.
They are doing it anyway right now. So there will be no difference.
Well, they're doing it now, but if they get caught, like Silk Road is a good example, they were taken down. I mean, I agree with you. It'll happen anyway. But I'm just saying the technology is a double-edged sword, right? We are going to have that future. Like, it's going to happen. So get ready.
And the even more interesting part is that imagine if somebody will put autonomous artificial intelligence to blockchain, to such kind of decentralized
totally
internet. And
I totally agree.
Autonomous artificial intelligence will start, doing many crazy things. Will start living their own life and multiplying itself and creating the newest version of itself, etc.
I don't think that's very far away. I actually think that's really going to happen. Personally, I think AI would be an excellent replacement for human trust because it doesn't involve a human. Like I totally see that happening. I think you have predicted the future. Honestly, I do. I think that's going to happen. So, yeah, very interesting. Very interesting. You look at like these transformers. So, you look at like ChatGPT. So what am I using right now? I'm using this one, Claude AI. I don't know if you've used this yet, the Opus. It's really good.
It's open source.
It's not so open source. It's like Llama's more open source. So this is someone who came from OpenAI. But ChatGPT, same thing, right? You got these large language models, and they use this. Let me put in here architecture. I'll show it to you now. My spelling is not great, so I don't know if you've ever seen this thing before here. But for those watching who have never seen this, this is what is behind ChatGPT. This is the artificial neural network technology. And what it's really good at doing is looking at sequence. So, when you give it a string of words, so my cat sat on the mat, it understands the relationship of the word mat to cat. It is able to have the sequence look at itself I'm putting it very crudely. Now apply that to trading, right? When we look at trading, so let's go back to our example here. When we're looking at these bars, for example, we're looking at sequence. These are words with different structures and different meanings. And something very interesting that I did a research project on is what if we take this here and we apply it to this? So if we take this and have it predict this, do we see some edge? And the results were not fantastic, but they were not undeniable. There were some results there. And it was really interesting to see how this AI, to your point, how this AI is being used to basically now to be used within trading.
Yeah, so
it's
you already integrated AI with your tools, or you are going to do it?
I haven't done it yet. And the reason for it is there's not enough edge. So like if I was to bring in AI, I need to be able to objectively say, every day when you turn up to this, you will have some kind of edge having this as opposed to if you didn't have it. And it wasn't robust enough. There's a lot of like statistical tests I have to do before I let the public have access.
Yes.
It wasn't strong. And the reason for it, and by the way, you'll probably find this interesting because we're nerds and we like this stuff. But like the reason is because there is so much randomness in price. So when you look at something like in physics, like information theory, the more information in something like, I don't know, let's put in Solana, right? Solana is heavily traded. the more information in Solana, the more random the price movements are. And that's because there's more information in the asset. It's just physics.
Yeah.
This is just a law of the universe. And what you'll find is the more randomness there is, the less effective this is. Because what this neural network does is it learns through compression. It compresses data.
So to summarize it, so basically, if we want build neural network and train a neural network on some assets, better to choose low cap assets with lower volume, because probably there is not much competition on there.
100%. It's so funny. I tell you a story. I never heard of crypto early 2017, right? So early 2017, my friend says to me, he's like, Shaun, you need to check this crypto thing out. I'm like, what the hell are you talking about, man? He's like, no, dude, these things are like stocks. Like you can buy loads of them. They go up and down in price. He's like, check it out. I was like, oh shit. I said, could you arbitrage this? And he was like, I don't know. No one said arbitrage. Like, what's arbitrage? And I was like, holy shit. So I had a look at this and I was like, oh my God, there's so many cryptos that the volume, it was so funny, man, because you probably remember, you were there in 2017. There were these cryptos where literally price would do this. It would like go down. So this would be a red candle, and then it would go up, green candle, and then it would go down, red candle. And literally you could set up a bot with like an order here to buy and an order here to sell. And literally like you could just with this low, to your point, like low liquidity, low volume, it was the easiest money ever. It was like stupidly easy. But today, obviously more people know this, so that has changed the market dynamics. But I think you know what I mean, right? It's much easier, like you said. Much easier, yeah.
Yeah, with less competition, much easier, yes.
Much easier. So I had one more thing to show you, by the way. Have I talked too much, or did you want to see?
Yeah, show me the last thing, yes.
Okay, all right, cool. So this is more for people that are not trading, they are more investing, they're looking to buy and hold some cryptocurrencies. And as you know, it's like, well, it's now a good time to buy. Should I buy? If I'm going to buy, what should I buy? And you know, for me over the years, it's been very easy to see the same thing work multiple times. And so I'm actually going to show that to you now. Have you ever heard of something called Metcalfe's Law?
No.
Okay. This is really useful because it helps us value a network without needing price. So it's not perfect, but it's like a rough way to objectively value a cryptocurrency without needing the cryptocurrency price. And so it looks something like this. What happens is, as the size of the network increases, its value increases. It's like if you have a telephone, one telephone, this is a telephone. Probably, maybe that's a rubbish telephone. We'll draw a telephone like this, right? So you have your screen, your telephone. One telephone is not very valuable. It's actually useless. It's got no value. But now you add another telephone that it can connect to. Now the network is more valuable because people can connect. And so this is why, for example, Facebook or social media has an intrinsic value, but so does crypto. Crypto has a fundamental intrinsic value. And this law helps us to gauge that value. And so, you know, what do we use as the sort of the underlying metric for that? Well, we actually use the daily active users. So we could use devices, but for example, so many people can connect to one node. So rather than using the amount of nodes, it's actually better just to use the number of people actively using the network. So this is what we will use. And let me show you some analysis we did last year, and then I'll show you the same analysis this year. So here we go. We have Bitcoin, Ethereum, Solana, Cardano, Aptos. So this was 1 year ago I did this analysis. And it basically said, okay, here's the daily active addresses. Solana, I couldn't get it back then. I had to use the unique fee payers, but same thing, same thing. And then what you do is you square that number, right? So here it's just that number times itself. And this gives us, I'm going to call this the Metcalfe number, right? It's not a value yet in dollars. Yeah. And then what you do is you take the circulating supply and you say, okay, if this is the intrinsic value as a Metcalfe number, what is the value per token? And that gives you this intrinsic value per token, right? So when you did it for Bitcoin, it got you to the number of 43,417 Metcalfe points per token. And then you have to say, okay, well, that's Metcalfe points. Like, what does that even mean? Let's apply a dollar figure to it. And so you look at the average cost of an internet connection is $1.05 around the world. And so you could use anything. You could use 50 cents, $1.50. You know, this part is a bit subjective, but I took the average cost of the internet globally, and that applies a dollar sign. Meaning in January the 5th, 2023, Bitcoin was worth 45,000. Now, if you're a value investor, say in the stock market, usually what you do is you come up with a valuation and then you take a margin of safety. So you half that valuation. When you half that valuation, you say, okay, if the current price is less than my safety price, then it's a good investment. And Bitcoin was at least 26% undervalued. Ethereum was showing as overvalued. Solana was showing as way undervalued. Cardano showing as way overvalued. And Aptos was showing as way undervalued, based on the usage and the supply and the network effect, the intrinsic value. And now you fast forward to today. So I took this price yesterday. This is yesterday's prices. So Bitcoin here, we can see, obviously everything's gone up because it's crypto. But the main point here is the ones that went up the most were Bitcoin, Solana, Aptos. These are the three that when they went up more than the other two. And that's because they were grossly undervalued, intrinsically undervalued. So now we can say, okay, what does it look like today? Like, is Bitcoin undervalued today? Is Ethereum undervalued today? Is it overvalued? Here's what it looks like. The only crypto out of, it's funny you mentioned ICP, because I actually put ICP here. I didn't know we were going to talk on ICP. But based on this approach, right now, Solana is significantly undervalued. And I actually believe this is true, because if you look at meme coin trading right now, it's all Solana, man. Like half of the volume in total crypto is Solana. It's Solana. So they've got nearly 1.3 million daily active users right now, with still a much smaller circulating supply than, say, Cardano. So when you do this analysis, like it's saying Solana should be like Ethereum. It should be in the thousands. Like it should be worth a lot more. And so it's saying Bitcoin right now, as a value investor, it's probably not as great a deal as Solana. So I thought I would share that analysis with your followers. I found it interesting.
It's
of course,
cool.
you take it with some salt, but it's interesting.
Yeah, it's interesting, but there are many different things that sometimes we should to take into consideration. For example, if we will add to this to this pairs also Arbitrum. Yeah. So I'm curious how the calculations will show what result they will show.
Yeah.
Why I'm talking about Arbitrum? Because Arbitrum, in my opinion, is undervalued because of number of projects on its network. Yeah. But there was a significant, huge inflation, huge amount of unlocks, token unlocks, around in April, somewhere in April. And because of that, the Arbitrum price went down massively past month because of that unlock, because of that inflation. So it's really cool that what you just showed, what you just show. I'm doing such compilation also, but yeah,
I
but
agree with you on Arbitrum.
we always should to also watch, for example, inflation and that unlocks. Anyway, Solana is interesting.
That's a really good point. What you said is a really good point. And I agree completely. I mean, there's a lot of factors. One of the things you mentioned is like Arbitrum. Arbitrum has a very good developer community. And there are a lot of projects happening on Arbitrum. The key question is, do those projects lead to more daily active users? In my mind, normally they do. And so if you're seeing price going down, and as you said, like activity going up, that's a divergence. It's probably a useful trade. I've done similar trades like that. Usually what I look for is I don't know about you, I look for like asymmetric risk. So let's say a price has been up here and now it's trading like this. Everyone has forgotten about it. I promise you I'm buying this. Because I know like traders are very, over long term trading, traders are very emotional and people forget about things and they're like, for example, oh, Dogecoin, that's an old meme coin. No one will give a shit about Dogecoin. No, I promise you in 2 years, 1 year, everyone's going to go, Dogecoin! You know, like Elon Musk is going to post and everyone's going to go, yeah, Dogecoin! And so you're like, no, you want to buy when everyone thinks it's dog shit. You know, and like if Arbitrum has had, like Chainlink was another one. Chainlink, a few months ago, it dropped significantly. And I was like, why does everyone hate Chainlink? And it was just some news that came out. I was like, holy shit, like Chainlink is like the godfather of oracles. Like, fuck this, I'm buying some Chainlink. so, you know, just bought Chainlink. And I don't know, that strategy just works very well for me. You know, like that divergence when you know most of the selling pressure has been taken out. You know, it's very similar to this. It's like when the selling pressure is taken out. Where's Doge? Let's look at Doge. I like Doge. I love Dogecoin, actually. When the selling pressure... By the way, I don't own Dogecoin anymore right now, just in case you're wondering. But like, you know, I'm seeing this like selling pressure is taken out of the market. Yeah, I'm probably want to think about buying that. You know, that's for me personally, maybe not for you or someone else, but for me, it makes sense, you know? Anyhow, that's all I had for you, Julian. Thank you for letting me talk so much.
All right. Did you show something anyway? Did you show something?
What's that? I know I said thank you for having me and letting me talk so much.
Okay. Okay. You know, the tools that you showed me are really interesting, and I would love to hear more about it. I would love to invite you maybe to my community. So
I'd love to. I'd love to chat with your community, and also I'd love to have you on my channel, Julian. So if you're happy with that, it would be really good because I saw some of the stuff you did, and I said to my wife, I said, "Holy shit, this guy's got some really good software." So I'm interested to hear more about what you've done.
Let's do it. Let's do it. Okay. So I'm finishing the stream right now, and we'll talk after all.
Great. Thanks very much, Julian.
Thanks. It was a pleasure.